The most dangerous lie in retirement is not that the government will come one day and slash your check in half. The most dangerous lie is smaller than that. It is the lie that if nobody announced a disaster, then nothing important changed. I have spent my life watching how people think about money, and I can tell you this: most fortunes are not damaged by one dramatic event. They are damaged by friction, they are damaged by silent leaks, they are damaged by paperwork nobody filed, thresholds nobody watched, premiums nobody challenged, and formulas nobody bothered to understand until the money was already gone. That is why a retiree can open a bank account, see a deposit arrive, and still be losing ground. The government knows how to move slowly. Bureaucracies rarely take with a headline. They take with complexity, they take with timing, they take by making one increase look generous, one deduction look automatic, one withholding look normal, and one appeal look optional. Then they wait for you to accept the number on the screen as if it came down from heaven. I never built Berkshire by accepting numbers just because they were printed on official paper. I wanted to know what the number meant, what assumptions sat underneath it, and who benefited if I never asked the next question. That habit matters even more in retirement. When a person is still working, a mistake can be repaired with another year of labor, another bonus, another promotion, another overtime season. When a person is retired, every dollar lost to confusion is harder to replace. You are no longer building with fresh earnings. You are defending accumulated capital and the income streams attached to it. That changes the game. So let me give you the main idea in plain English. Your retirement is not usually hurt by the change you see. It is hurt by the interaction you do not see. A cost of living adjustment looks like help. A Medicare deduction looks routine. A tax threshold looks old but harmless. A government pension offset sounds like a technicality. An earnings limit sounds like somebody else's problem. Put those together, and a retiree who thought he was stable can find himself losing hundreds of dollars a month without ever hearing the words benefit cut. That is the real story. Take the cost of living adjustment. In 2025, Social Security benefits rose by 2.5%, and the average retirement benefit went up by about $50 a month. That is the official language. And the official language is not false, it is just incomplete. The increase began with 2025 benefits, not as some magical rescue that suddenly appeared out of nowhere months later. It was real money. But the minute you stop there, you begin telling yourself a comforting story instead of the whole story. The whole story is that retirees do not live inside an average inflation basket. A retiree does not buy the economy. A retiree buys his own life. He buys prescriptions. He buys electricity. He buys insurance. He buys help for a spouse. He buys a roof, not the consumer price index. He buys one grocery cart at a time, and he feels each increase in a way a government formula never can. So the first discipline in retirement is this: never confuse a nominal increase with real relief. If your check rises $50 and another deduction quietly takes 10 or 15 of those dollars back before the money even lands in your account, your real raise is smaller than the headline. If your premiums rise, if your pharmacy bill rises, if your property taxes rise, if your grocery bill rises faster than your check, then the arithmetic of your life is harsher than the arithmetic of the press release. The older I get, the more I respect arithmetic without theater. Retirement planning is not supposed to make you feel better for a day. It is supposed to keep you solvent for a decade. Now, let us move to the next layer. And this one is more important because it involves money that many people should have been receiving all along. For years, millions of public workers were caught in two provisions that sounded like they had been designed by people who never had to live on a fixed income: the windfall elimination provision and the government pension offset. Most people never learned those names until after the damage had already been done. Teachers learned them, firefighters learned them, police officers learned them, postal workers and state employees learned them, widows learned them, and what they learned was ugly. A person could spend part of a life in work not covered by Social Security, earn a pension there, spend another part of life in work that did pay Social Security taxes, and then discover that the Social Security benefit he thought he had earned was going to be reduced by formula. A surviving spouse could discover that a spousal or survivor benefit was cut or eliminated because the government treated her public pension as a reason to pay her less from her spouse's record. This was not a morality play. It was a rule set. And like many rule sets, it punished people who had done exactly what society said was honorable. That changed when the Social Security Fairness Act was signed in January 2025. It repealed both WEP and GPO-SSA, then began adjusting affected benefits on the 25th of February. 2025, with retroactive relief back to January 2024, and most affected beneficiaries began seeing higher monthly payments in April 2025 for March benefits. That is real. That matters. That is not a talking point. That is cash. But here is the part that interests me even more than the law itself. A law can change. A system can still move slowly. If millions of records need recalculation, if retroactive payments are owed, if notices are mailed in batches, if individual histories are messy, then the people who assume the machine will perfectly clean itself up are making a dangerous bet. The machine is not evil. It is just a machine's process. They do not care. If you or your spouse had any non-covered public employment and ever wondered why the Social Security check looked lower than it should have looked, this is not the moment for passivity. This is the moment for verification. A retiree who checks, calls, and follows up is not being difficult. He is behaving like an owner. The retiree who says, "I am sure they got it right," is behaving like a customer trapped in a monopoly. In business, I learned long ago that when there is a pile of money on one side of the table and a complicated process on the other side, you do not assume the complicated process naturally favors you. You audit it. That same principle applies to Medicare. And Medicare is where one of the quietest leaks in retirement begins. Most retirees never write a check for their standard Part B premium. The money is usually deducted from their Social Security benefit before the deposit hits the bank. That makes it psychologically invisible. Invisible costs are the costs that grow the fastest because people do not argue with them. They simply adapt around them. In 2025, the standard Part B premium was $185 a month. That alone was enough to claw back part of a retiree's COLA before he ever saw the increase. But the truly expensive layer is not the standard premium. It is IRMAA, the income-related monthly adjustment amount. IRMAA is one of those fine examples of how the government can use an old tax return to send a new bill into your life. For 2025, Medicare looked back to 2023 income. If a single filer was above $106,000 or a married couple above $212,000, higher premiums began to apply. And they did not inch up politely. They moved in tiers. The first higher 2025 Part B premium was $259 a month, then $370, then $480.90, then $591.90 at the top tier, $628.90 per month per person. That is not a rounding error. That is a rent payment in some towns. Now ask yourself a simple question. How many retirees feel wealthy when that surcharge arrives? Some do, of course, but many do not. Many had a one-time property sale. Many had capital gains in a strong market year. Many converted retirement assets. Many retired after a peak earnings year. Many sold a business or took a required distribution or liquidated something they had held for years. The tax return looked high. Their life now may not be high. IRMAA does not care unless you make it care. That is why one of the most valuable forms in retirement may be a form many people have never heard of. SSA 44, the life-changing event appeal. If income dropped because of retirement, work reduction, divorce, death of a spouse, or certain other qualifying events, there is a path to request lower IRMAA, not a favor. A process I want you to understand the deeper lesson, because the lesson is larger than Medicare. A surprising amount of retirement damage comes from treating a determination as a verdict. It is often not a verdict. It is a starting position. You can appeal, you can document, you can correct, you can challenge, you can ask the system to update stale information with current reality. People who do that are often not smarter than everyone else. They are simply unwilling to outsource their dignity to a default setting. Now let us talk about the working retiree, because this is where many people get angry for the wrong reason. If you claim Social Security before full retirement age and continue working, the retirement earnings test may withhold part of your benefit if earnings exceed the annual limit. In 2025, the exempt amount for someone under full retirement age the entire year was $23,400. In 2026, it rose to $24,480. In the year you actually reach full retirement age, the higher exempt amount applies to earnings before that month, and then the test disappears once full retirement age is reached. What matters here is not simply the number. What matters is the planning. A person hears that benefits are withheld and concludes, the government is stealing the money forever. That is not the mechanism. SSA later recalculates the benefit upward to account for months withheld. But the cash flow pain is still real in the meantime. and cash flow pain is what households actually experience. You do not pay the electric bill with a future actuarial adjustment. You pay it with this month's bank balance. That is why I tell people to stop turning every retirement question into a moral question and turn it back into a design question. You do not ask, is it fair? You ask, what does this do to my cash flow, taxes, timing, and optionality? Those are owner questions. Then there is the tax trap that offends almost every retiree the first time he feels it. Social Security benefits can themselves become taxable depending on combined income. The thresholds are old, frozen, and ruthless in their own quiet way. Roughly speaking, for married couples filing jointly, once combined income passes $32,000, up to 50% of benefits can become taxable, and above $44,000, up to 85% can be taxable. The equivalent thresholds for many single filers start at $25,000 and $34,000. These lines have sat there for decades while real life has moved on. That means more retirees get pulled into taxation, not because Congress courageously raised taxes in broad daylight, but because inflation and time did the work in dim light. That is how governments often operate when direct confrontation is unpopular. They let static thresholds do dynamic damage. You can hate that, but hatred is not a strategy. Planning is, if you know those lines exist, then IRA withdrawals, Roth conversions, realized gains, part-time work, and even certain interest income stop being isolated decisions. They become interacting decisions. The retiree who thinks, I will just pull a little extra this year, can discover that the little extra triggered more taxable Social Security, perhaps nudged Medicare risk later, and changed next April. Tax Bill 1 decision, 3 consequences. That is why retirement income is not simply income. It is sequencing. In my world, capital allocation always beat activity. The same thing is true here. The question is not whether you are doing a lot. The question is whether each dollar is being pulled from the right place at the right time, under the right rule set. Now, I want to speak to the psychology of all this, because the psychology is what wrecks people. Retirees are often exhausted by complexity. They spent 40 years being told to contribute, wait, trust the system, and let professionals handle the details. Then they finally retire and discover the most valuable years require more vigilance, not less. That feels unfair, and it is. But unfairness does not remove the obligation. It sharpens it. If you are retired or approaching retirement, you need to think of yourself less like a beneficiary and more like the chief financial officer of a small enterprise. The enterprise is your household, your revenue lines are Social Security, pension income, portfolio income, wages if any, and withdrawals. Your expenses are fixed, discretionary, medical, tax-related, and surprise expenses. Your job is not to hope the system is kind. Your job is to audit, allocate, and adjust. That is what the best operators do in business. And the same temperament serves you in retirement. The retirees who stay calm and strong are usually not the ones with the absolute highest balances. They are the ones who know where the leaks are, which forms matter, which thresholds matter, and which phone call cannot be postponed. Another 6 months. Let me make this concrete. Imagine a retired couple. The husband worked part of his life in private industry and part in public employment. The wife taught school for 30 years. For years, they assumed their benefit numbers were simply what they were. Then one of them hears that WEP and GPO were repealed. They check their record. They discover the wife's spousal benefit had effectively been crushed by rules that no longer apply. They follow up. The monthly amount rises. Retroactive money shows up. That is not an investment gain. That is not market luck. That is administrative recovery. Now imagine the same couple had one unusually high income year 2 years earlier because they sold a property. Medicare is charging them IRMA based on a reality that no longer exists. They file the appropriate appeal with evidence of retirement and lower income. The premium falls again, not an investment gain, not magic administrative recovery. Now imagine they are also drawing from an IRA without thinking about combined income. Their tax preparer tells them after the fact that more of their Social Security became taxable than expected. That is not fate. That is sequencing error. You see what is happening here. For many retirees, the biggest untapped opportunity is not some hot stock, not some forecast about rates, not some guru's macro chart. It is getting the household rule book under control. That does not sound exciting. It is wildly profitable anyway. The market pays you for good behavior slowly. Bureaucratic vigilance pays you by preventing stupid losses. And stupid losses compound. $100 a month here, $200 there. a premium reduction, a corrected benefit, a better withholding choice, a tax trap avoided over 10 years. Small leaks become large holes or large savings depending on whether you behave like a passenger or an owner. So what should you do? Not someday. But now, first log into your My Social Security account and read your record the way I would read an annual report, not casually line by line. Check the earnings history, check the estimated benefits. If something looks wrong, treat wrong as expensive until proven otherwise. Second, if there was any public sector work not covered by Social Security in your history or your spouse's history, revisit the account with fresh eyes. WEP and GPO are gone. That fact alone justifies a new review. Do not assume somebody already fixed everything in the background, exactly the way it should have been fixed. Third, examine your Medicare premium. If you are paying more than the standard amount, do not merely sigh and move on. Ask what tax year they are using, whether your current income is lower, and whether a life-changing event appeal is justified. A retired person who saves $200 a month in premiums did not save $200. He bought back control. Fourth, if you are working while collecting Social Security before full retirement age, calculate your earnings against the annual exempt amount. Do not guess. Do not rely on memory. Use the actual number. Bad surprises usually happen to people who were approximately aware but not exactly informed. Fifth, stop pretending Social Security taxes are an afterthought. If you are drawing from retirement accounts, planning capital gains, or doing conversions, understand combined income before year, and rather than after the return is prepared. A mistake discovered in April is still a mistake. Sixth, remember that your benefit is not your deposit. Your deposit is your benefit, minus deductions, minus premiums, minus withholding, minus the consequences of choices you made elsewhere. That distinction sounds obvious, but most people live as if the deposit is the whole truth. It is not. The whole truth sits behind the deposit, and that is where your work must happen. People like to hear that retirement is finally the season, when life gets simple. I have never found that to be true. Retirement is when labor income becomes less central and decision quality becomes more central. The good news is that decision quality can improve very fast. Once attention improves, you do not need 10 years to stop making unforced errors. You need one serious week. Here is the irony. The same people who once watched every line of a paycheck stub often stop watching the mechanics of retirement income, even though those mechanics may matter more. When you are 45, a payroll error is annoying. When you are 72, a benefit error, premium error, or tax sequencing error can change your standard of living. That is why I would leave you with one test. Do not ask yourself whether Washington is being fair. Ask yourself this: if someone took away your headlines, your outrage, your favorite commentator, and your fear, would you still know exactly how your Social Security check is being built, what is being deducted from it, what old tax year is driving your Medicare premium, whether any past rule reduced your benefit improperly, and what form you would file if the answer was wrong? If the answer is no, then your retirement is still too dependent on trust. And trust in money should always be earned by verification. The people who stay strong in retirement are not usually the people who receive the kindest system. They are the people who learned how to read the system before the system read them. That is the real shakeup. Not that the rules changed, it is that the rules were always changing, and now you finally see how much money lives or dies in the gap between an official announcement and your willingness to do something about it.